Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CENTURI Holdings INC quarterly report. CENTURI Holdings Inc. offers a range of services to utility providers and end markets across North America. The company's primary businesses include gas utility services, maintenance, replacement, repair, and installation for local natural gas distribution, utilities, electric utility services, maintenance, replacement, repair, upgrade, and expansion for urban transmission and local distribution infrastructure. The company serves a variety of customers, including electric, gas, and combination utility providers, end markets such as plus renewable energy, plus data centers, plus 5G datacom. The significant increase in CENTURI Holdings Inc. CTRI stock price over the past year can be attributed to several key events that have generated strong positive sentiment among investors. Notably, the company's 52-week high of $24.60 on January 24, 2025, represents a 69.99% increase from its 52-week low of $14.46 in April 2024. Several factors contributed to this upward trend. In November 2025, CENTURI reported record quarterly revenue of $850 million, an 18.1% increase over the previous year, which led to an 11.73% stock price jump. The company also secured nearly $400 million in new commercial awards and completed its separation from Southwest Gas Holdings, becoming a fully independent entity. Additionally, CENTURI's positive earnings report for the fourth quarter and fiscal year 2024, with revenue rising by 7.8% and adjusted EBITDA improving by 22.9%, likely contributed to the stock's performance. These events collectively demonstrate strong growth and financial stability, which have likely attracted investors and driven up the company's stock price. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the increasing demand for outsourced utility infrastructure services, particularly from utilities' system integrity management programs and customer attention to environmental objectives. Additionally, renegotiation of major contracts, master services agreements, and unit price contracts have contributed to revenue growth. Key drivers of revenue growth include system integrity management programs, growing customer attention to environmental objectives, increased demand for outsourced utility infrastructure services, renegotiation of major contracts. On the other hand, revenue decline is primarily driven by a decrease in Canadian gas sales and a decline in revenue from contracts with Southwest Gas Corporation. Net income and profit margins shift in 2025. The financial summary reveals a mixed picture of net income and profit margins for the fiscal periods ending September 28, 2025. Notably, the company transitioned from a loss to a profit in the 3-month period, with a significant increase of $5,731 in net income. However, this improvement was not sustained in the 9-month period, where net income decreased by $9,422. Profit margins also underwent changes during this period. The gross profit margin and operating profit margin both declined in the 3-month period, decreasing by 1.4% and 1.6%, respectively. In contrast, the 9-month period saw a slight decrease of 0.2% in the operating profit margin, while the gross profit margin remained unchanged. The reasons behind these changes are not explicitly stated, but they may be attributed to various factors such as shifts in market demand, operational efficiency improvements, or adjustments in pricing strategies. The company's financial performance indicates a concerning trend. Despite its efforts, the business is struggling to generate positive operating cash flow. In fact, the numbers reveal a significant shortfall in this area. According to the financial summary, the company has been experiencing negative operating cash flow, with a staggering minus $5,769 reported on page 8. This alarming figure is further confirmed on pages 46 and 47, where it stated that the company is indeed generating negative operating cash flow. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, there has been a notable increase in long-term debt from $730,330 in 2024 to $797,621 in 2025. Additionally, borrowings outstanding under the amended credit agreement have increased from $0.8 billion to $0.9 billion. However, accounts receivable sold to PNC has reduced the company's debt level by $125 million. Regarding interest expenses, there has been a decrease of $932 due to amortization of debt issuance costs. Furthermore, interest expense, net decreased by $2.3 million and $8.3 million in different periods compared to the prior year period. The company's financial performance varied across different segments and regions. The U.S. gas segment showed significant growth, with a 12% increase in cost of revenue over 3 months and a 2% increase over 9 months. Similarly, the Union Electric segment performed well, with a 25% increase in cost of revenue over 3 months and a 14% increase over 9 months. On the other hand, the Canadian gas segment struggled, experiencing a 36% decrease in cost of revenue over 3 months and a 5% decrease over 9 months. The non-union electric segment also had mixed results, with an initial 23% increase in cost of revenue over 3 months, but a significant decline in capital expenditures by 35% over 9 months. Management is optimistic about the company's outlook, citing opportunities for growth in a consolidating market. They are well positioned to meet increased demand from utility system replacement programs and believe they can support customers' environmental goals through infrastructure construction and maintenance. The company will continue to invest in capital expenditures to meet anticipated needs, while also planning to refinance existing debt with new term loans. Overall, management is confident in the company's ability to navigate a potentially challenging market landscape. The company's financial summary highlights its acquisitions and divestitures activities over a specified period. In terms of acquisitions, there were none mentioned throughout the report. However, the company engaged in several divestiture activities to dispose of non-core assets and reduce its ownership stakes in certain entities. Key divestitures include the sale of Century shares plus 21.6 million shares through secondary public offerings, plus 3.9 million shares to Icon Partners LP, and Master Fund LP plus remaining shares sold through final secondary public offering sale of property and equipment for $4.6 million in the fiscal 9 months ended September 28, 2025, and $6.8 million in the fiscal 9 months ended September 29, 2024. These divestitures demonstrate the company's efforts to optimize its portfolio and reduce its financial obligations. There are concerns about inventory buildup and supply chain disruption. While the company believes it has taken steps to secure delivery of necessary equipment, potential impacts from tariffs on equipment price and availability could lead to disruptions. Additionally, delays or cancellations of projects due to various factors may also affect supply chains. That concludes the financial summary for CENTURI Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.